Hello mga kamaniwise! Welcome back to my channel! Today, pag-uusapan natin ang isa sa pinaka-iconic na Philippine stocks, ang Jollibee. Dating market favorite dahil sa kanyang growth story at global expansion. Pero recently, bumagsak ang share price niya due to two reasons. Disappointing first quarter 2026 earnings report and tanggal pa siya sa MSCI Philippines Standard Index. Kaya double whammy ang nangyari sa JFC. Year-to-date return is negative 24% and one-year return is negative 44%. Ang tanong ay, temporary lang ba itong pagbagsak ng price ng JFC at may pag-asa pa kayang makabawi ang JFC stock? So if you're currently invested sa JFC or planning to buy while the stock price is down, make sure to watch this video until the end. Before I start, quick shoutout muna sa mga bagong YouTube channel members kay Romeo Frejas, Dulce David, Romeo Labando, Ruth Kabiling, Lilibeth Campos, Kate C., and Jeffrey Fegarido. Maraming salamat for joining as channel members and supporting my YouTube channel. I really appreciate your support. Ang dami na ring brands ang JFC. Meron silang global icons like Jollibee, Smash Burger, Tim Ho Wan, and Coffee Bean Tea Leaf. Meron ding multi-country favorites, beloved local brands, and franchise brands. Now let's look at JFC's consolidated first quarter 2026 earnings. If we look at the top line, the business still looks healthy. Revenues grew 9% year-on-year from 70.2 billion pesos to 76.5 billion pesos. The company is still growing. However, if we look at the expenses, tumaas ang direct cost by 11.7%. From 57.2 billion pesos to 63.88 billion pesos. Mas mataas kaysa sa revenue growth ng company na 9%. And because of that, gross profit fell 2.9% from 13 billion pesos to 12.7 billion pesos. Normally, when revenues grow, profits also grow. But in Jollibee's case, kinain ng rising cost ang revenue growth. Kaya nagkaroon ng margin compression. Bumaba ang gross profit margin niya from 18.6% to 16.5% due to higher inventory cost, raw material inflation, and higher logistics expenses. Bumagsak din ang operating income by 18.2% year-on-year. Then after operating expenses, financing cost, and taxes, net income declined 43.6%. At dahil bumagsak ang earnings, bumagsak din ang share price ng Jollibee. Kasi share price usually follows the earnings growth. Tapos natanggal pa siya sa MSCI. Kaya lalo pang bumaba ang share price niya. Now, let's dig deeper into the segment breakdown because this is where the profitability issue becomes more visible. Based dito sa data, international operations already contribute 42.4% of global revenues. So, almost half of Jollibee's sales now come from overseas operations. International operations also contributed 43.2% of global gross profit. So, malaki na ang international business ng JFC. Kaya lang despite contributing 42.4% of revenues, international operations only contributed 13.4% of operating income. So, that's a huge gap. The overseas business generated a lot of sales pero mahina pa rin ang profitability. International operations contributed negative 52% of global net income after tax. The Philippine business naman contributed 152% of net income after tax. Ang laki ng profit ng company from its Philippine business, kaya lang hinatak pababa ng international operations ang overall net earnings ng JFC. Clearly growing ang international business, but the real issue is profitability ng kanyang international business. If we look at the gross profit margins, international operations actually look okay. Nasa 16.9%, which is slightly higher than the Philippine business at 16.3%. However, if we look at the operating expenses and advertising cost, international operations spent 15.2% of revenues. So much higher than the Philippine business at only 8.5%. The overseas business is spending much more on operating costs like rent, labor, advertising, logistics, and expansion expenses. And because of that, international operating income ay mababa, nasa 1.6% lang, compared to the Philippine business which generated 7.7%. So ang laki ng profitability gap ng Philippines and international business. Then after financing cost and taxes, international net income after tax margin turned negative 2.4%. Despite generating large sales overseas, JFC's international business is still not generating profits relative to its size. Now let's look deeper into JFC's EBITDA breakdown. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. This gives us a clearer picture kung aling segments ang profitable and which businesses are dragging earnings lower. First, the Philippine business. The Philippine business EBITDA declined 7.1% year-on-year from 6.64 billion pesos down to 6.16 billion pesos. JFC's core Philippine business also showed slower profitability growth sa first quarter, affected ng geopolitical tension sa Middle East. International EBITDA naman was relatively flat, declined by 0.7% from 2.93 billion pesos to 2.91 billion pesos. However, if you look at the breakdown, mixed ang performance ng international brands. Some overseas brands perform well, yung mga naka-highlight ng green. As you can see dito sa data, China improved significantly from negative EBITDA last year to positive EBITDA this quarter, plus 183.2% siya. Asian brands also posted slight growth at 1.8%. Highlands Coffee grew EBITDA by 9%, and Tim Hortons surged 287% year-on-year. Not all international brands are performing well. Yung naka-highlight sa red, ang hindi maganda ang naging performance. North America EBITDA declined 23.5%. Ang kanyang smash burger remained a major drag, posting negative EBITDA, so down 29.7%. Milkshake declined 41.3%, and composed coffee also declined 12%. So while JFC's international business continues to expand globally, hindi pantay ang profitability niya across different brands and regions. Sa ngayon, the biggest challenge for JFC is turning that international business into sustainable and profitable business. Sa ngayon, mataas ang utang ng JFC. Debt-to-equity ratio is 109.75% with cash of 28.54 billion pesos. Interest coverage ratio is 2.8 times, which is still acceptable, pero manipis ang buffer niya. In terms of action plan, according to management, JFC is implementing a 2.8 billion cost containment plan to help restore margins and improve long-term profitability. They plan to focus on disciplined and balanced cost controls and more selective expansion decisions. They will continue investing in businesses that generate very good returns, like Tim Hortons as an example of delivering very good returns, while becoming more cautious with capex and operating cost. JFC is now trying to balance global expansion with stronger profitability and better cost efficiency. And plano rin ng JFC mag-cost increase starting second quarter ng 2026 alongside sourcing and productivity action. In the short term, JFC's share price will likely remain under pressure due to rising inflation, which is expected due to weaker consumer spending and higher cost. And until now, wala pa ring clear signs that the war in Iran will end soon. Kaya magiging volatile pa rin ang share price ng JFC. Pag natapos ang gera sa Middle East and conditions improve, pwedeng makabawi rin ang JFC. Overall, JFC still has a path to recovery. Sales are still growing, tumaas ang revenue, kaya lang sales growth was slower than expected due to rising cost. According to management, margin pressure is largely driven by macroeconomic factors. Management attributed the higher cost mainly to higher commodity prices and supply chain inputs due to ongoing tensions in the Middle East. These are considered serious headwinds, pero hindi naman siya permanent. Kapag nag-normalize ang oil prices, logistics, raw materials, and packaging materials costs, margins can eventually recover. So let's see how JFC's management navigate these challenges and whether they can successfully turn things around. Reminder, this is not an investment advice. Investing in any company comes with risk, so always do your own due diligence before investing.